Welcome to the Multifamily Deal Room, where we actually help people close deals in this platform. Okay, I'm your host Cornelius Cannon, and a lot of people ask me how you pronounce my name. It's pronounced Cornelius. I know it's spelled different. I am a little different. You want to reach me? You can reach me at Cornelius at multifamilydealroom.com. Now, today's agenda, we come in two parts. The first part, we actually have a real presenter present their deal to our panel of deal makers. Now, the purpose of the first part is to actually get real feedback from real investors. Now, you learn how these investors on the panel, you sit there and discover what kind of question they ask, what kind of how they analyze deals, and you gain your confidence and resources and knowledge to invest, become more comfortable to invest as well. Now, the deals that I'm presenting tonight, if you like, feel free to reach out to the presenter. If you like the deal that been presented, feel free to reach out to the presenter directly. And they also will be in our second part of the show. Is actually our breakout room. And in our virtual networking, they'll be in deal room number one. You get direct access to the syndicators and so forth. You can ask what questions you want to know and get and these are real deals with real people. Now, the purpose of this show is to help you gain the knowledge, the support, and resources so you can gain the confidence in investing in these deals before. Now, how we do it, because of a lot of people say, man, I wish I would have known this 10 years ago. So the best bet thing, instead of going backwards, then the best thing is actually to find people who 10 years ahead of you and figure out what they do in your position. So tonight we have on our panel, we have a couple experts who've been doing multifamily for quite some time now. First up, we have George Roberts the third. Is George here? And we also have Scott Kidd and Dave Peters. Keep calling Dave Peterson. So let me let them talk from themselves so you can see who are these individuals in the house tonight. First up, we have Dave Peters. You there, Dave? Hold on, I spotlight you.
I am. Can you hear me?
I can hear you fine. How much you want to take?
All right. Yeah.
Hold on. Wait, Dave. Hold on. Wait. I gotta do my stuff. I apologize. I have to do it. Hold on, Dave. All right, hold on. All right, here we try again. Okay. I gotta introduce my dream team. Yeah. Okay. All right, first up, we got Dave Peters. Go ahead, Dave. You ready? Go ahead. Tell about who you are and how you help.
All right. Yeah, I guess I'm getting known eventually as the hotel conversion guy. Started in real estate back in about 2004. Licensed general contractor, single family flipper, single family portfolio, multifamily stuff, and since 2019 hotels.
Outstanding. Thank you so much, man. So next up, we have the captain himself, Scott Kidd. How you doing, Scott Kidd?
Oh, pretty good. Scott Kidd, multifamily investor. I'm a LP investor, co-GP, and Upraise Capital. And also have my own personal portfolio. And we are starting a fund for multifamily as well. So been doing it for a while, but enjoy the intro. I feel like I should run in high five everybody, but I can't.
Got to cheer for that one. So now that you know about us, the question is, we want to know about you. In a couple moments, you're gonna see a couple things pop on your screen. We want to know more about. The first thing you want to say is, why'd you come to this event? Okay. In the moment, here we go. Why'd you come to this event? No, where you at in your investment journey? Okay. Are you just getting started? Are you knowledgeable and ready to invest in buy more properties? You own a couple properties, looking to invest. Consider yourself an expert. Are you a vendor looking to find some people? Let's see, where are you at in your process? Five, four, three, 2, 1. All right, stop the polls and share results. All right, great deal. So we have a few people who's actually just getting started. No problem, great place to do it. Some people actually knowledgeable and ready to invest their first deal. People actually own a couple properties looking to invest more. Some people, some experts here, and also some vendors. Once again, afterwards, it's gonna be a great opportunity to stay around to network with people as well. Okay. Next question I want to ask you. Why'd you come to this event? Okay, why you come to the event? Are you need help finding deals? You need finding capital, looking to gain more exposure? Why'd you come to this event?
Baby, I'm playing on you tonight. Hunt you down, eat you alive. Just like animals, animals like animals. Whoa. So maybe you think that you can hide. I can smell your scent from miles. Just
2, 1. All right, stop the polls and share the results. Now, let's say so we got a couple people looking for find some deals. Some people actually can help find capital. Some people looking to gain some knowledge. We got 5% looking for their soulmate. Good deal. We can make that thing happen. All right. All right. Stop sharing results. All right. Now, third question. I want to ask you. We know it's not about what you know. It's not about who you know. It's about who knows you and what they know you for. So, the question I want to know is, how can you help other people? What can you be known for? Okay. So, the question, see the thing pop up. Let's see how can you help other people. Let's see what you got going on. 5, 4, 3.
I'm gonna fight 'em all. A 7-nation army couldn't hold me back. They're gonna rip it off.
4, 3, 2, 1. Okay, so in the post and share results. Okay, I'll start. Here we go. Share results. Here we go. We got some people can help find deals. Some people can help find capital. We got 41% can help with knowledge, and we got 5% of soulmate. We can make this thing happen, right? Outstanding. Now, so now our next up is our actually event. But before we go to that, we want to turn it over and share some information from one of our preferred vendors, one of our preferred partners of the night. Okay, let's see here. Are you there? Oh, wait. You muted. Are you there, Steve? Try not, Steve. You muted.
There it goes. I think I'm live now.
Yeah, we hear you. We got you.
Alive. Good to be alive. Thanks, Cornelius, and thanks to you, incidentally, for bringing all this together. I know you've worked on it for many, many months. I wanted to talk for just a minute about the cap rate. You know, what is the cap rate? I think some even experienced investors not really sure, but it's one of the most commonly used terms right in our business. So the cap rate is what would the return on my money be, my investment, if I didn't have a mortgage, a commercial property, and I decided to pay cash for it. So if I paid cash for it, I wouldn't have a mortgage, right? And therefore the NOI is all cash. That's going to be the return. And that's the definition right there. It's one of the 3 standard methods that an appraiser uses. And, you know, there's the comparison approach, the income approach, and the cost approach. So the appraiser mixes all 3 of those together and comes up with the final opinion of the value of the property. So the capitalization rate is the most commonly used method for buyers and sellers to determine the property value. And it varies from submarket to submarket. And the cap rate is easily accessible as far as information for those different submarkets. You'll easily find it in CoStar, for example. So it's just another way to value properties. It's the most common way. It's not absolute by any means. So it's what's the return on the property that I'm going to buy if I didn't have a mortgage and I paid cash for it. Most commonly used method to value properties. It's not absolute. It's just one of the 3. So one other thing I wanted to mention to you is that we've got numerous ways to fund properties, private money, agency money, bank funds. We're offering a 20% reduction on origination fee, which equates to about $5,600 savings if you run a deal through us for the rest of the year, because you are participating in the multifamily dealer room tonight. I'll put my contact information up on the chat box. We're here to help you. We would appreciate the opportunity to fund your deal. Thanks, Cornelius.
No problem, man. Thank you so much. Thank you so much. Now, one of the best things of the show, the picture. We need the picture, right? So now please turn your cameras on and let's do our deal maker poses, our money poses for this social media. Turn your cameras on. Let's get this thing rolling. Ready? So y'all turn your cameras on real quick for me. For my camera picture, people still joining. All right, here we go. I'm gonna get my camera ready. Ready? Show me your money. 1, 2, 3. Yeah. Bam. All right, now people. All right, one more time. Now, ready? Show me your camera. Show me the money. 1, 2, 3. Bam. Outstanding. Thank you so much. All right, now we have Ray and Tom. You ready, gentlemen?
Yes, sir.
All right, got you. So whenever you're ready, you got the flow. So what you're gonna have is 20 minutes to present your deal and get the audience wrapped and so forth. Then after that, they will actually give feedback and give ask about your deal and ask questions. The panel will ask questions as well, and then we'll help you get the deal funded. Okay, you ready?
Perfect. You're good if we share screen here?
Yes, sir. You space your screen.
Perfect. Great. Thank you all for having us on tonight. It's an absolute pleasure to be on. We are longtime viewers, first time talkers on this, but tonight we are presenting the U, which is a multifamily workforce housing deal in Indianapolis. We are Terra Capital, and this is a 60 unit, 49,500 square foot multifam property in a very recession resistant market that is under a value add strategy with Terra. We are buying this property at $73,000 per door. We are adding $23,000 of renovation per door. And our total development cost all in at the end of the day will be $106,000 per door. We will hold this over a 5-year period, and we've modeled for a 2.1x LP multiple, which translates into a 21.6% LP annualized return. And it comes out to an 11.5% stable coupon post renovation. Skip right through our disclaimer, which we've shown, and onto the deal info.
So before I jump into the executive summary, I just wanted to say thank you so much for having us again. And I wanted to give you the 5 main reasons why this is a great deal. The first is that the U is located in a great neighborhood in a recession-resistant market, and we're targeting the most recession demographics in that market. The second is that we are doing a heavy value add project where we can renovate to top of market standards, but we're still well below replacement costs. The third is that we're getting in at a phenomenal basis for a number of reasons that we're all very aware of, one of which is high interest rates. The second is the sub-institutional size of this deal, and we can get into that more later, but being 60 units, there's less competitors in this space. And third, the seller is very motivated, which we can add more color onto later. Fourth is we are providing phenomenal potential returns, as Ray outlined, but I just wanted to add 2 additional pieces of information. We are offering institutional hurdles for only a $25,000 ticket. And we can get into what that means later on. And 5, and this is my favorite part, in this crazy market with cap rates expanding, interest rates going up, it's hard to find a deal that makes sense. This is a great deal during a crazy time. So now, just quickly through the executive summary, Terra Capital is raising $2.7 million. The U will be renovated to top of market standards. We're targeting the 2.1x multiple on invested capital, and we are in a recession resistant market. The submarket that the U is located in is a neighborhood called Beech Grove. The reason we named and we're rebranding and renaming this property is because the shape of the center structure is a U. It's 60 units across 2 sides. It's 49,500 square feet. There's 60 outdoor parking spaces, 22 covered parking spaces, and 18 storage spaces. But most importantly, this is the worst small to medium-sized multifamily property in the whole neighborhood. It is the last property to be repositioned. Beech Grove, if you know Indianapolis well, is a phenomenal neighborhood. People love it. Everyone you ask, Beech Grove is great. This property is the one that's holding the area back. So from a value add investor standpoint, it provides an amazing opportunity.
And one of the things that we're most excited about with this deal is simply the overall market in Indianapolis. So we've targeted Indianapolis for a long time. We're very active in that market, in addition to a number of other very similar markets in the Midwest. But Indianapolis in particular is a growing city. It has an excellent culture. It's fairly large by Midwest size. It's an MSA population of 2.1 million, very low unemployment rate. It has a number of superlatives: best convention city, underrated city, good city for food, etc. But what we like most about this market is that it's anchored in extremely recession resistant and growth industries. So you can see in the middle of this slide here, these are the industries that really hold up this market. It's life sciences and biotech. It's insurance and financial services, which especially in this case are medium and low cost location versions of those jobs. So they're really the last to be laid off of that industry, which is nice going into a recessionary environment. It is also anchored by healthcare, which is one of the stickiest employment bases, and they have a handful of rapidly growing healthcare systems in the city. It's the major headquarters of a number of large companies, international ones, some of which you recognize, like Rolls-Royce. It's a major logistics hub for a state that's very based on ag and has a lot of logistics needs. And finally, it's the state capital of Indiana. So there are a lot of underlying government jobs that form the bedrock for the employment base in Indianapolis. It has on the right here, you can see a trailing 12-month year-over-year rent growth that's in the low double digits that beats out a lot of the markets that you see across the US that people are also very excited in investing in. And this is just a testament to a couple of things, but most importantly, is the supply and demand imbalance. There is a lack of supply of quality housing in this market. And so operators that deliver high quality units are rewarded for that. We have seen that firsthand in this market, and we're hoping to continue that trajectory with the U. You can see here quickly an average rent growth over time for Indianapolis versus the average market vacancy rate. So average rents have been going up, and it's been on the up for 5-6 years. And you can see that steadily all the way since 2004, there's been a real decline in the overall market vacancy rate. And right now we're sitting at that low level of vacancy rate, which is likely a steady state for the city in the long run. So it's been an improving multifamily rental market. Here is an image of Indianapolis overall and the neighborhood that we're focused on here in Beech Grove. So Beech Grove is a neighborhood in the southeast corner of Indianapolis. It's relatively close to downtown. It's very much so in that broad Indianapolis loop. It is the birthplace of Steve McQueen. So he got a little shout out on this slide. And it is also the home to a number of major employers, including hospital system, University of Indianapolis, and a handful of large big box retailers, including 2 Walmarts in the immediate vicinity. So there's a lot of local employment job bases, which is important for a workforce housing style deal. But also because it's such a short drive time to the rest of the city, it has good access to all of the healthcare systems that are called out on this slide as well, relatively close to the Colts Stadium, and is overall considered to be a nice neighborhood. Beech Grove in a little bit more detail, just around some of the employment centers that are here. There's a couple of Kroger's, Lowe's, Walmart. High school is very close to our property, which is called out here with the horseshoe. Our property is located right between a golf course and a very nice park, but is pocked in general with a bunch of nice parks in the area. There's a family amusement park. The Franciscan Health System is actually just right down the road, their campus in Southeast Indianapolis. And the University of Indianapolis is a very close drive nearby as well.
So we just wanted to take a quick intermission and give you a little bit of background on ourselves and our company for those of you who don't know us. My background is in real estate development and operations. After getting my real estate license while attending Columbia University in New York City, I went and I worked for one of the largest private developers in New York, a company called Rose Associates. At Rose, I did large scale multifamily development and adaptive reuse, similar to the hotel conversions that were brought up earlier. My most notable project was the acquisitions of the old AIG headquarters in the financial district, 1 million square foot Class C office building, that rose while I was on the development team converted into 700 plus luxury rentals. After working in the private space, I went and worked in the public sector. I worked for the Lennar Corporation doing ground up multifamily development in New York, New Jersey, Connecticut, and Pennsylvania. All told, and now I should mention I run Terra Capital's real estate development and operations teams. All told, I am very close to hitting that 2,500 unit mark, either renovated or developed.
And Ray Hyman here. My background is more in investment management and acquisition strategy. And acquisition strategy is where I really focus for Terra. But before Terra, I kicked off my career at JP Morgan in investment banking. I covered US real estate and REITs while I was there. I then moved on to Booz & Co, where I sat on their acquisition strategy desk and worked on just over $3.5 million worth of corporate transactions while I was there. And finally, I worked at Saberica Capital, which is a Boston-based private equity fund doing healthcare, technology, and real estate. And I identified and closed on just over $750 million worth of private equity transactions in that role. And Tom and I have said this 1,000 times, but we really see these two backgrounds and their combination together is really the fundamental DNA of Terra Capital. Going out there and putting together a modern acquisition strategy approach to identifying excellent deals, the U being among them, and then leveraging that best-in-class real estate development background that Tom brings to bring full circle value-add properties to market at strong returns.
So back to the deal. And we'll get into as deep of the weeds as we want to go, but at a high level, we're buying this property all in for $6.38 million. Our sponsor equity portion of that is 5% of the equity. That money is cash that's pretty much already in the deal. We are raising 2.5 million with the minimum ticket size being 25,000, and we're getting a senior loan for 3.6 million. Once completed and fully renovated, this project will stabilize at an 8.35% yield on cost. We talked about cap rates at the beginning, very similar concept, said in a different way. Net operating income divided by your total cost. That will translate to a 2.1x MOIC and a 21.6% LP net annualized returns. These returns are all net of fees. I should mention that I think it's important for people that are focused on underwriting and this type of analysis. We're holding a 6.5% cap rate exit, which is greater than what we're buying at entry and is 25 basis points over spot cap even in this market. So with a 6.5% cap rate exit in year 5, which I think is very conservative, we're still able to drive these very high returns. So I'll get into this and I can answer any questions on this later, but we will acquire the U this summer. Over the following 20 months, we will turn units and renovate them. And we have some photos of our typical type of renovations that we do. Our team has already completed over 30 multifamily value add renovations. So you can get a feel for the type of execution we do on our projects. We'll then, after we fully release the units, we will harvest the property, fully stabilized. We're holding a 4.8% vacancy rate, which is in line with the market. But even with that level of vacancy, we're able to drive on average 11.5% quarterly coupon. And then we'll prepare for exit in year 5. We will go through a brokered process as a part of Ray and I's and Terra's greater strategy. Our goal will be to sell this as a part of a larger portfolio, but either as a larger portfolio or as a standalone asset, we still believe we'll be able to drive that 6.5% cap rate at exit.
Now, one of the things that we mentioned towards the beginning is that The U is really one of the last properties to be turned in this neighborhood, which is an excellent opportunity for us because although our work is cut out for us in the physical world, in terms of comps, we have great examples of other operators that have done something very similar, and we can see exactly what level of success they had, especially on the rental side of things. So there are a couple of comps that we just wanted to go through quickly so that we can sort of establish the baseline for top line rent income and what we're thinking. The first is 140 North 9th, which is at the top of this list on the left. You'll see the second on the list here is the U post renovation and where we've projected rents. We've got our 1 beds at $1,050, our 2 bed 1 bath at $1,190, and our 3 bed 2 bath at $1,350. You'll see that we pegged these rents to the 140 North 9th, and we'll go through that comp a little bit, but it's very similar. It's very close. We will slightly beat on the interior quality of renovations, and we will dramatically beat on the exterior quality post renovation. So we feel very confident that we can hit these numbers and there is upside to it. But for underwriting purposes, we've stuck to what the comps tell us. And then the Beech Tree Glen apartments, which are also close by Indianapolis standards, are slightly below where our rents are and where our rents are projected to be. But that is truly a B+ property. I think you'll see it in the pictures. And you can see on the right-hand side, we like to think about rent in terms of rent per square foot, especially when we're looking at this type of housing and workforce. And you can see we're right between that A- and B+ comps that we've identified for the 1s and 2 beds, and then a very, typical market curve out to where we have set our 3 bed rent. Now, the first property on here, 140 North 9th, you can see it has a nice exterior. I would argue that it's very similar in quality to where the U is today. Although we'll talk about it, we're going to add a lot to the exterior of the U to really bring it to the top of market. But the interior standards that you can see here on the right are very similar to what we do. We'll make a couple of improvements on this, including going after engineered hardwoods instead of the LVT that's here. This unit still has popcorn ceiling. There are a couple of other items in the bathroom and shower body that you actually can't see well in this picture that we will not go after. But this sets a good baseline for what a nice quartz countertop, white subway tile backsplash, chrome appliances type of renovation will get you in this market right down the road. And this is a 48 unit property, so very similar in size to what we're working on. And then here you go with the Beech Tree Glen apartments. These are what we've called a B+. That might be a little bit generous. Rents are significantly, they're still high, but they're below where we are projecting to. And you'll see that there's a lot in their renovation, or in some cases lack thereof, that we wouldn't do. So you've got the old LV tile, you've got a lot of carpet throughout, you've got in many cases not quartz countertop, you don't have that stainless steel appliances, you have dark cabinets, so on and so forth. And so we add a lot of value by going and looking a little bit more like this 140 North 9th versus this Beech Grove. So we see that we believe that we will significantly beat these rents. And so we like that as a lower bound comp for what we're looking at.
So before and after for the U, a great representation of what it looks like today is probably this comp, but a little bit worse, carpeted everywhere. No, not even LVT, not even gross LVT in the kitchen or living space. What we do and our thesis and what we believe in is actually spending the money when you're doing a heavy value add, not cutting corners, not cutting corners. We will be spending approximately $20,000 a door. If you look at the right-hand side of the screen where it says after, oh, okay. If you look at the right-hand side of the screen, when you can see our after. This is the type of finishes that we normally do. We will be doing the same exact level of finish at the U. I think for just because of time, it doesn't make a lot of sense to dive into each individual line item on our renovation budget, but we like to have a real meaningful renovation budget. We don't like to hold $7,000 a door, $14,000 a door. We like to really add that padding so that we can execute our plan. What I would like to mention, and I think maybe the next slide is better for it, but we will be doing meaningful exterior improvements. So we'll be adding a dog run. We will be doing hardscaping. We will be doing a pergola. We will be increasing the curb appeal. We will also be doing meaningful landscaping. We'll be doing a monument or a large sign where there isn't a good one now. We'll also be lime washing the whole entire property, and we'll be partnering with a local school to do a mural on the so it's new limestone that will be, it's existing limestone that we will be lime washing, and then we'll be adding a mural to that. Whenever you do a heavy value add project, especially when you're taking the worst property in the neighborhood, but phenomenally located, what you need to do is you need to rebrand it. Everyone that drives through Beech Grove sees this project, and the beauty of workforce housing and what I was always told when I was at Lennar is that whenever you're doing a deal like this, visibility and curb appeal are the number one and number two most important things. You need people to see that now leasing sign, and you need people to be attracted to the property. And we get the privilege to increase, the overall aesthetic of the neighborhood.
And we're getting close to the end here, but we did want to hit on what we think is a very important part of not only the U, but our strategy here at Terra in general. We'll keep it U specific though here, given the subject matter. But right now is a particularly good time for what Tom and I are working on. And we've got 5 reasons outlined here, just general macroeconomic reasons. One is, while there's a recessionary environment and recessionary fears floating around, we operate on a very specifically recession-resistant strategy. It starts with the market, which we talked about a little bit. And this particular one is very focused on those sticky, last to be laid off, recession-resistant job bases, but it also is a good example of a market that did well or did flat through the 2008 financial crisis, where we've got the home price index here on the right-hand side, where the US is sort of tumbling out of control, but Indianapolis is flat to slightly down. And there are a number of other things that are important to us for recession resistance that I'll get to in a second, including being conservative on leverage. 2, like most multifamily opportunities, we provide an excellent hedge against inflation. Indianapolis is seeing high single and in some cases low double-digit rent growth, while costs remain largely flat. And a lot of that rent growth is driven by inflation in addition to market dynamics that are specific to Indianapolis. And so when that happens, real estate and multifamily operators like us benefit tremendously. But unlike a lot of multifamily operators and opportunities right now, we provide a good shield against interest rate rises. And the main reason for that is that our yield on cost, or cap rate, are well above where interest rates are. I know we were talking earlier about getting agency in the high 5s. We're stabilizing this property at 8.35% cap rate with upside. And so we still have a significant spread between where we stabilize our property on cap rate and where we can get lending. 4, this is workforce housing, which is one of the more recession-resistant options in recession-resistant markets. So we're specifically targeting those last to be laid off folks in the market. We're very specific about our rental requirements in terms of credit score and earnings as a multiple on monthly rent. So we get sort of the best version of that workforce housing, but it's a great part of the market to be in going into recessionary environment. And lastly, we invest on a 5-year horizon, and this is a 5-year hold period deal. And so we are really striking at that right time where we can get that very low price per door, that's $73,000 per door, but then exit in 5 years when the market is back on an upswing, and really maximize the outcome of the work and the hard work that we have put into this deal. And just quickly on recession resistance and minimizing risk, I think there are a lot of operators out there that will pick places or pick strategies that aren't as safe, that are riskier, That's not us. We are about risk adjusted returns. We focus on conservative leverage, returns based on value add, not just on appreciation. We sell at market peak and buy when the market is at a flat line or not doing as well. We have very high tenant standards as mentioned. So we're going after the tenants with the best credit score that won't be late on rent, that won't become difficulties for cash flow. We focus on workforce housing and we target major job centers. We talked a little bit about why we're so excited about Indy and Beech Grove in particular. And a big reason is that there's a lot of major job centers very close by. And so our properties are well located in order to take advantage of that workforce housing positioning.
So here, and it may actually just be easier. Normally we would share this presentation with you, but we made it easier today. These links go to various resources that we have to learn more about us, to schedule time, and it can all be easily accessed at our website, usaterra.com. And there's a link on the top of the website to register now. And then it's an automated process to get access to our due diligence folder, to get subscription docs, and everything along those lines. We made it as easy as possible.
And we use Juniper Square, which is a great software that makes it a breeze to learn more about the deal, look at the VDR, ask us questions, and sign subscription docs in a very short amount of time. We would also invite you, if you have more questions as follow-ups, to send us an email, info@usaterra.com. Quick way to get in touch with us.
So I wanted to spend a minute on this, and I think this is important and something that Ray and I are really focused on. So this is, Terra Capital's philosophy on growing our business. Both of us come from an institutional background, and we brought that level of hurdles and returns into the sub-institutional space, and we're giving access to accredited investors those same hurdles. So we're offering a 7.5% preferred return. And then after that 7.5% preferred return, we are only doing a 80-20 split. This is often referred to as a 2 and 20. But what that means is after you've received all your money back, you've gotten your 7.5% return annually, only 20% of the additional money made goes to the sponsor, 80% then goes to you. We're conservatively underwriting this. We touched on a lot of those points. Happy to dive in any more detail. But with those conservative assumptions and that waterfall, the potential for very strong year-over-year returns for the LPs is there. And that's something that we take pride in, kind of providing that, not a 70-30 split, not a 60-40, not a 50-50, that institutional 80-20.
And to Tom's point, what we're most interested in right now in our firm's overall trajectory is getting introduced to and developing relationships with investors that want to be with us for the long term. We are in these markets long term. We've been here for years. This is what we do. And what we want to do is grow alongside our investors, rather have our investors grow alongside us, so we can keep deploying on deals like this and funds like this over and over again.
That's it.
Oh, you might be on mute there.
I'll thanking me now.
Yeah, there you go.
I get there. Let me do this real quick. First of all, we gotta do our polls real quick. So let me do a quick switcheroo real quick. Give me 1 second, because somehow we got a little jitter. All right, so first we're gonna go to our first. Can you speak about the asset management property? So forth? Okay, gotcha. You have some questions in the chat real quick, but first we're gonna go to our panel, our deal panel. Scott, you up? You ready, Scott?
Yes, sir.
Go ahead, Scott.
Okay. I just had a couple of quick questions. Said the acquisition fee is 2%. Is there a disposition fee or a asset management fee?
There's 2% asset management fee on equity, no disposition fee, and 2% acquisition fee.
is there a capital transaction fee, like when you refinance or anything like
No.
that, or
Nope.
no, none? Okay. And what is the economic vacancy of the area compared to everything else?
It's pretty in
Yeah.
line with the market average. Beech Grove is generally speaking a very nice neighborhood. It's majority single-family homes. The comparable vacancy is a little hard to determine. We've blind shopped it. We've talked to the leasing managers, and we've tried to rent vacant apartments at a below rent number to test their vacancy. And it appears to also be in line with the market around that 4 or 5%.
Okay. And what compared to purchase of single family homes in the area?
Sorry, you lagged out. Happy to answer that though.
Oh, okay. What is the rent compared to purchase of home in the area?
So for 2-bedroom, if you wanted to rent a 2-bed at the U, you would be spending about the same on your monthly, very kind of, giving the homeowner the benefit of the doubt, pretty much in line, 2 beds to 2 beds. And then your total cash payment for a single family home owner locally for a 2-bed, 1-bath house would be about $50,000 in equity. The average sales price, not including transaction fees, is $168,000.
Oh, okay. And it's a 20-month, 20 months, you're gonna turn all the units, or
Yeah, that's the plan.
every single one of them? So it's about roughly 3 per month?
Exactly right.
Yep.
We'll front load that. We've received the leases. There's a lot of expirations that will get non-renewals this summer. So we'll front load that conversion process with the goal to turn the smaller property first and capture the best residents at the larger property into the newly renovated smaller property. And then we'll start to do a slower trickle of 2 to 3 to 4 units a month to conservatively hit that 20-month schedule. With a 30-month schedule, say we miss and it's 10 months off, which it won't be, the returns only go down by 100 basis points, maybe less. So it's still 20% plus IRR.
And as far as the median income of the area, what percentage?
55,000.
55,000. So that's 30% of that is, yeah, that covers the rental for those.
We love
As-
Indianapolis because that equation works. I think especially when you're doing anything recession resistant in mind, having that quote unquote affordable rent or being by that golden line is really important to us.
And as far as are there any new developments in the area that would be competing with you guys?
So there was a project slated for a start in 2021 down the road, 220 units, but was not able to proceed because of the cost per unit. And that's why we love this deal, because our total fully renovated limestone facade, new units, new amenities, and I forgot to mention we're adding a gym as well. We're able to stabilize that property in the low 100s, where to build something similar to that would be $200K a door or more. So we don't believe that project is going to get off the ground.
Even if
Okay.
it did, we would still be at a 35 to 40% discount on rents versus that project,
Yeah.
which is where Terra's properties typically sit. So it's a meaningful discount and it attracts effectively a different band of renters. So we're not as worried about large scale development stepping in.
I underwrote, and I do it all the time. My background's in ground up development. I looked at land and being able to build in Indy, even at a 0 land basis, like you got the land for free, it'd be near impossible to go ground up today.
In
Just where
Indianapolis?
SOFR is, et cetera. So
Okay. All right, that's all I have there.
So I forgot to ask the audience. My apologies for the delay. Now, in the question, I want to ask you, the audience, on a scale of 1 to 10, how do you rate this deal? Let's go. Yeah, 5. One more time. 5, 4, 3, 2, 1. Share results. Let's see what we have here. Good deal. Share results. We got some 10s. Take my money. We got some 7s, some 5s, and also we got some good feedback. Some say people, I'm not sure. No problem. We're gonna ask some more questions as well. Now, my second question I want to ask you is, if you could invest in this deal, how much money would you invest? Let's see. Let's go here.
Baby, I'm playing on you tonight. Hunt you down, eat you alive. Just like animals, animals like animals. Whoa. So maybe you think that you can hide. I can smell yourself for miles. Just like animals.
5, 4, 3, 2, 1. In our polls and share results. Okay. We got some 100,000. Share results. Got some 100,000, some 75s, some 50s, some 25s. We got a good mix of feedback there. Okay. Now, my third question, a little serious question. Would you like somebody to reach out to you about investing in this deal? Let's see. The poll's up. Let's see what you got. If you'd like somebody to invest out with the deal. Yeah. 5, 4, 3. That's more people come out. 2, 1. Eyes in that. No problem. All they'll be there in the breakout room. Next up, Dave Peters. On a scale of 1 to 10, I want to know, how'd you rate this deal, my good man? How'd you rate this deal?
I rated it a 6, but I need more information.
Okay, gotcha. Let's go.
All right, so, well, first of all, there was one question in the chat that I'll just reiterate for you guys. I guess the 2% asset management fee, is that based on the equity or is it gross receipts?
Oh, wait, Jimmy, y'all muted. You there? Rain.
Perfect.
Still muted.
Equity.
Okay, so that's a little different than when most people think about it.
I think it's industry specific.
Yeah, generally speaking, in the multifamily industry, usually when people talk about asset management fees, they're talking about 2% of gross receipts.
Now, wait, real quick. Let's start that for a minute. For those who don't really understand it, could y'all elaborate what that means for the audience, for the people who actually invest in this deal? The two.
Yeah. So we're kind of talking about the difference between an asset management fee as a sponsor and property management fee as a manager of the property, if I'm understanding that the distinction there correctly. Asset management fee is something that's collected by the sponsor of the deal. It is sometimes a percentage of different things, as Dave pointed out. In our case, it's a percentage of the equity that's committed to the deal. And that 2% is paid annually. And it is typically considered to be the way that the sponsor sort of keeps the lights on. It's how they cover costs for asset managing the deal. Now, the asset management and property management fee has more to do with the day-to-day management of the property, collecting rents, making sure that maintenance tasks are taken care of, so on and so forth. Especially for the first 2 years while we're working on renovations, we will keep the existing property managers in place. It's a group called Intempus. It's a group that we know from Indianapolis, and they're extremely familiar with the property, so they'll be very helpful to have on board. And we would not convert to an internally managed process until later. Intempus is an 8% management fee, and we are a 6% management fee. So post renovation, post lease up, we would switch over to Terra's property management service.
Thank you, sir, for the elaboration. What's up, Dave? What you got?
Well, Joe asked another question, and the answer to that, Joe, is it's a $2.7 million raise. So it'd be 2% of 2.7 million as opposed to 2% of revenue. So on a 60 unit building, what would you guys project for annual revenue on that? And by the way, I just caught something. It's 2 different buildings. Is that correct?
That's correct.
They're on the same. We can actually share. If you let us share here, we can show.
You see share?
Yeah, there we go. It's 2 properties built at the exactly same time. They're part of the same complex. You can see here is the U-shaped, which is the namesake, and then there's this I-shaped property That's 42 units in the U shape and 18 units in the I shape.
Okay, so basically, I mean, they're just two buildings on the same plot of
Yeah.
land. It's not actually two different properties. There for a minute when you said it, I thought maybe you had two, like two different properties that were maybe separated by a block or something like that.
Exactly. It's not that. It's just two structures on the same lot, built at the same time, effectively the same property.
So stabilized revenue, 900,000, 2% of that, call it 20,000. If you were to charge an asset management fee based off of gross receivables, and we do it on equity based off of our backgrounds and our experience. And it's probably around 50,000, just back of the envelope.
Right, so it'd be 54,000 versus 18, I guess.
Correct. Although if it were calculated on gross receivables, it'd be a higher number, but yes, you're right. It'd be a high percentage, but you're right.
Okay,
People often use 75 basis points on total deal value. It's another way people calculate asset management fees. With leverage, that brings you typically to a 2% equity management fee.
okay. All right, so it's a 67 build, is that correct?
That's right.
And what is the structure? I mean, is it just typical stick built? Or
Yep.
is it,
Stick built on grade with limestone facade.
okay. So I assume you guys reviewed it, no issues with like asbestos still hanging out or
No,
lead paint or any of that kind of stuff?
no, phase one came back clean.
Okay. I think it's good that you've got a fairly decent size per door renovation budget. Now, you said your exit cap was 6.5%. What's your entry cap?
6.2.
Okay, so not too different. I think 6.5 is reasonable in that market. What are you projecting for rent growth there? I know you mentioned that, the last year or so, I mean, you had like 10% rent growth, but I mean, I think everybody was pretty high over the last couple of years, and I think it's going to pull in quite a bit.
We hold 3% as a company rule. We don't like this concept of trying to see the future. I've attended many kind of projection conferences, and I've never really seen it be accurate. So to benchmark it and be conservative, we hold 3% year over year. And we also have a sensitivity table in all of our models that shows the returns and stress tests our models. If we have 1%, if we have 2%, if we have 3%.
We do that across markets. In this market, we're very confident that we would beat that, but we would rather have that upside show up at exit and not during the underwriting.
And the rents that you quoted there, the 1050, the 1190, the 1350, is that your baseline starting rents?
No, that's our stabilized rents. Our baseline rents on average are $400 less than that. And just as a reminder, this is the worst property in the market.
So very different tenant base, very different rental product post renovation.
Sure. Yeah, I mean, it's a major reposition. I did do a quick search. I have a tool that kind of rates neighborhoods, and it looks like you guys are sitting right on the cusp of a B and a C. I mean, is that kind of where you guys feel like the neighborhood is?
I would say, yeah, I would say Beech Grove, like in total is a B. Is at least, my understanding of the neighborhood and our presence in the market.
It does
But the
look like you
feel of
guys
this
are on the right
property-
side of the street, though. It looks like it's like literally the street you guys are
Yeah.
on is like a BC divide line, and you guys
Yeah.
are on the B side of the line.
And I would argue that our property is dragging down the neighborhood. Like it is a meaningful enough property that has not been value added, that with that level of improvement would make that divide even stronger. We know a lot of people in the community. We know people that are in support of this repositioning.
Now, you guys are based in New York, correct? Or is just one of you in New York?
I'm in New York.
I'm based in Cleveland, which is where I'm from originally. We invest predominantly in the Midwest, so Pittsburgh, Columbus, Indianapolis are our target markets. I'm drive time / quick flight to all three of them. So that said, Tom is in market just about every other week, so he comes and says hi.
Okay, so you're essentially sort of the local partner then.
Indeed.
And then we've been working on projects there for a while. We have local service team members that we work with and such.
Have you done like a heavy reposition like this in the market before?
We have. We did it on the other side of Indianapolis on the north side. It was smaller, roughly 20 units deal, but very similar profile on resident and strong outcome so far.
And same contractors you think will be doing the project, or?
Yeah, they're a Columbus and Indianapolis based group that we do a lot of projects with.
We actually met and started working with them in Columbus, but they also have operations in Indy, so we've kept the relationship cross market.
We'll run an open process, but we have they know our finishes, we have a good relationship with them.
They work quickly. It'll be relatively easy to hit our 20-month target with them.
Okay, so moving on, I guess, what's the current like economic occupancy of the property now?
91%.
Does that project out that you guys will be able to maintain a break-even cash flow, or do you guys have some negative cash flow that you're covering there?
Year one will be slightly negative, -2%. We have a very
Right.
healthy reserves though. And that's
Okay.
also assuming that 3 unit a month turnover, which we expect to beat substantially.
So if you're going to beat the 3 unit turnover per month, that would then basically say your vacancy is going to have to be a little higher, right?
No, we would repurpose the existing units for, that's an interesting question. Our goal would be to vacate as quickly as possible. We have reserves in the deal to have a fully empty building for 3 months. So we're well covered. The way it's underwritten we would have less vacancy, but the overall returns and success of the project would be better if we vacated the building faster.
But you're right in the sense that, for sure, right in the sense that when we turn a unit, there is vacancy associated with that. So if we turn them earlier, then the first year we'll have more vacancy than it otherwise would have. That's definitely true.
So do you have a rough number on like how much working capital you have in the deal?
360,000.
Okay. And then I just saw that slide really quick on the loan. Is it true that the term of the loan is 12 months?
So what's on there is an interest only period.
Okay.
Is 12 months. The term of the loan will be a 30-year amort. The stabilized loan will be agency.
Right. What was the loan set up as like one of these loans where it sort of automatically what's the term of the initial loan, the actual like note term?
We're running an open capital markets process right now. We have underwritten a bridge loan with a 3-year term and 11%. We've gotten quotes lower than that. But I don't know the answer to that. We're running an open process. We have a handful of people bidding on it.
Yeah, we have a 9 and a 9.5, which are great. We've underwritten to an 11 with a group that we work with a lot, but we do an open market process on all of our lending structures.
So in your underwriting then, when you're projecting these returns, what did you project then for your interest rate in the underwriting process? It sounds like you don't have currently have the initial loan locked up yet, as far as the exact terms.
We have letters of commitment. We just haven't chose the best loan. Agency, we're assuming that interest rates stay where they are, which no one knows. We're stabilizing 3 years from now. We're holding a 6.5% interest. We're stabilizing this deal at a low 8% yield on cost. So debt is very accretive at that point.
Right, but that's still, I'm not sure that answers my question on the front end. What does the
11%
loan look like?
interest.
Are you saying it's like 9 to 9.5%?
11, we're currently holding in the model 11% interest until we're stabilized.
Okay, that was my question.
But we already have term sheets for 9.5% IO until we're stabilized. So we'll likely go with something slightly better than that.
Okay, yeah, that was my question. I just wanted to verify that. Okay. And then as far as you talked about paying coupon on it, are you talking like starting those payments in year 3 or where does that come in?
Assuming 3 units a month, coupons will hit month 14. But will ramp up at full stabilization at month 20.
Okay, and there's, is there actually like, you said you have a 7.5% pref, does that then accrue from day one or?
Yeah.
Yep. It accrues from close date.
Okay. So 7.5%, 80-20 split, no waterfall beyond that, just straight 80-20 split
Yep.
forever. And then I noticed that the other thing is, I think you mentioned like the 21%, and at one time you said a 21% AAR, and another time you said a 21% IRR.
Yeah, 21% project level IRR. That was the misnomer.
Okay, so it was IRR and not
16.7% net IRR to LPs.
Okay.
I mean, y'all think I have some questions in the chat as well if you want to go through that a little bit.
Yeah, I guess I think those were. Oh, the last question that I had was just related to comparable amenities. Now, the property that you guys comp to, how big is that property?
48 units.
48 units is the one that we're pegging our rents to. And
Okay,
the
that
property,
was the one that was just to the east of you guys down the road.
Yeah, 4
Yeah.
minutes.
Okay, and comparable amenities.
none, 0.
Okay, 0 amenities for them, just nice finishes.
Yeah, decently nice finishes that we believe we will beat, and an exterior that we believe will be significantly below ours post dog run, post parking lot, so on and so forth.
So you guys are gonna have like a fitness center, a dog run, gazebo, some nice outside, but like, I mean, I understand the property's fairly small, it's 60 units, so no pool, no clubhouse, no community rooms, but
That's right.
that's comparable to the one down the street, so.
It's a meaningful advantage, having the gym in those outdoor areas.
Okay. Well, I think that's all I had.
Gotcha.
Excellent.
So how you rate this deal? What's your number? Good deal. I was thinking, I mean, good choice. All right, good deal. You have a question in the chat. However, I go to our next portion of the show. Now they will be in deal room number 1. Now, if you have questions about how to get to deal room number 1, I will show you right here. You bring up room number 1, and they will be there.
If we miss any questions too, we can follow up directly.
Gotcha. Yep. Good deal. So I'll see you all in the rooms. Let's go.
Baby, I'm playing on you tonight.